Hey guys, hope you're doing well this evening. Just want to talk about Salesforce for a few minutes over here. So looking at the chart, we can see that over the past couple of weeks, we've actually filled that gap back from a few months ago, back in August 25th, when it jumped from a closing price of 216.05 to a high at the time of 277.97. That was on a monster earnings report a few months ago. And we actually had a great report a few weeks ago as well. However, because Salesforce decided to acquire Slack, ticker symbol WORK, the stock price actually fell as the market didn't react favorably to it. Now, looking ahead, I see this as a great opportunity for longs here because we have filled that gap now. And I do expect some bullish price action going forward. And so looking at the expected moves based on the option market pricing, we can see that for this coming Friday, December the 18th, the upper expected move is 225 or somewhere around here. The lower expected move is 215, which is somewhere around over here. Now, if you go out to the January 15th OPEX, that's actually 2021, we can see that the upper expected move is 239 approximately, so right in this area, which would actually fill that gap on the downside we had back from 241.35 closing price when we gapped down to 220.78 closing price, right? So that would be a gap fill right there by the January OPEX, which is about a month away. On the downside, the expected move would be 201, so right over in this area. That's for January right there, right? Now, as we go to February OPEX, we can see that the expected move is roughly to the upside 247. So we get in this area over here. And to the downside, it's about 193. So right over here, right? And then obviously going out one more month further to March OPEX, which will also factor in a earnings report as well, we get an upper expected move of 257 and a lower expected move of 183. So I would imagine that we'd only see these lower areas if we see a broad market pullback. Otherwise, this gap fill over here is pretty bullish in my opinion. And obviously do your own research, right? Take my word with a grain of salt. But looking at the implied moves each day, the option market is currently pricing in implied moves of 2.4% in either direction, right? And if you look at the implied volatility charts for the past 6 months, we can see that for Friday's OPEX, the options have never been cheaper since their inception, right? And then looking for the January, February, and the March OPEXs, the green is the March OPEX, the red is February, and the orange is January. We can see that they're trending downward right here. This is a great opportunity for buying puts or calls, depending on your thesis, obviously, and legging into spreads as we see the volatility ramp back up, assuming you're buying far out enough that you can benefit from that movement, right? So for example, you might buy a call option for March OPEX, wait for a move to the upside, and then sell a call option against it, creating a spread. And by legging in, you're actually going to reduce your debit substantially, although you do incur more risk at the onset of the trade, right? So let's look at that for a little bit right here, right? So looking at the option chain, we can see that for the January OPEX, if you want to trade shorter term, you can look at the at-the-money calls, for example, right? Going along over here and going short perhaps at the 240 strike. Now this means you're going to incur a debit of about $6.30 or so. Break-even price is 220 plus 630. And your maximum profit would be your spread width of $20 less 630. So your maximum profit would be 1370. And you have roughly 2-to-1 risk reward. So 2 units of reward per unit of risk, right? Which is pretty good overall. Obviously, max profit is realized at if the stock price finishes above 240 come January 15th, which is about a month away from today, right? Now, if you want to go further out and get some more time and then perhaps sell premium every week against your contract, you can do that as well, right? So let's say you want to go out to the February OPEX perhaps, and you want to target a recovery back up to the 250 area. You might go with something like the 230 perhaps, 250 or 260 call spread. In this case, you're going to incur debit again of 640 or 650 over here, roughly, right? And your maximum profit will be 30 wide in this case, less 650 for argument's sake, right? So your maximum profit would be 2350 on risk of 650. And again, your break even would be 236.50, right? Obviously, if you're bearish, you can do the same thing on the downside. Same spread width, similar strikes from the current price, right? But I'm pretty bullish over here on Salesforce, as I do believe they're going to recover nicely in the next few months, assuming we don't have a market pullback, right? And then last but not least, if you want to take a more synthetic approach and not really manage your position at all, you can buy a deep in the money call option, which pretty much acts as a synthetic position on the stock. Because in effect, if you buy, for example, like the 180 strike call option that expires in March, you're paying about 43 bucks over here, right? So 180 plus 43 is 223. You're paying about $3 of extrinsic value on the option contract. That $3 is a premium for both time and volatility. And your break even is then 223. So if, for example, we recover back up to, let's say, 240, all of a sudden your contract is now worth, from 43, it's now worth 60 bucks, right? So instead of buying the stock outright for 100 shares, you just buy one call option instead. Instead of spending $22,000 for 100 shares, you spend, the equivalent of $4,300 to have the equivalent of roughly 100 shares per contract. Not roughly 100 per contract. It is 100 shares per contract, right? But given the delta of 0.86, you're in effect controlling about 86 shares over here for 4,300 bucks, right? And obviously, if you buy that contract, you can, for example, buy that contract and then sell shorter duration contracts against it. So your break even is 223. So perhaps you sell, for example, the 40 strike contract against your contract, right? In that case, you actually eliminate that extrinsic value by pulling in $3 of premium at the 240 strike. Now, obviously, if by January OPEX it goes to 240, then essentially your 180 contract is now worth 60 bucks, and you paid 43, but you pulled in $3 over here. So your break even is pretty much 40. So you're making $20 on 40 bucks. So you're making about 50% return in the span of about a month, right? And then obviously you can sell for February and March as well. It's called a poor man's covered call, right? I'll end it here so it doesn't get too long. But if you have any questions at all, please leave them in the comments below. And if you like the video, hit the like button, obviously. If you love it, subscribe. And thanks a lot, guys. Have a great night and take care.